If you try to trade the broad equity market by watching thousands of individual stock tickers at once, the cognitive load will break you. Reacting to the daily churn of corporate news traps you in an emotional cycle, constantly chasing price action after it happens. Quantitative financial analysts completely ignore this daily corporate noise. Instead, they track the massive pipelines of underlying institutional capital flow. That capital does not move randomly. It shifts through the market in highly structured cyclical patterns. Consistently extracting alpha requires a systematic filter. It requires identifying exactly where that macroeconomic capital is flowing before the crowd arrives. To find those capital flows, systematic traders apply a top-down methodology. They start their analysis at the absolute highest level, the broad market indices, like the S&P 500. Then they segment that massive index into 10 distinct macroeconomic categories, like energy, technology, and retail. This division is mapped directly to a specific financial instrument, the Exchange-Traded Fund, or ETF, which bundles all the related stocks in a sector into a single tradable asset. Trading the ETF provides immediate transparency into sector-wide capital flow. It also mathematically diversifies away the risk of any single company going bankrupt. Unlike mutual funds, ETFs offer the identical liquidity and flexibility as an individual equity, including the ability to buy on margin or sell short. By restricting your initial analysis strictly to sector ETFs, you strip away the erratic corporate noise and isolate the pure mechanical movement of sector rotation. The challenge is anticipating exactly when institutional capital will shift from one ETF pipeline into another. This table shows historical quarterly performance data across the different sectors. Looking at the first quarter column reveals massive performance disparities occurring during the exact same timeframe. Isolating the energy sector, tracked by the ticker XLE, shows a dramatic 16.8% positive return. During that exact same quarter, the broader S&P 500 posted flat or negative returns. Capital is not evenly distributed across the market. It heavily favors specific sectors at highly specific times of the year, creating a measurable temporal edge for traders. To map these historical rotation probabilities, analysts rely on a quantitative tool called the Seasonal Trend Indicator. This chart shows the indicator's calculation method. It isolates the average price movement for every specific week of the year across an asset's entire data history, generating an aggregate trendline. This math works because it is driven by predictable, recurring macroeconomic and human behavior. Annual agricultural planting seasons dictate strict timelines for spikes in demand for raw materials and chemical fertilizers. Structured political election cycles routinely dictate the timing of legislative shifts that impact healthcare or defense spending. The seasonal trend indicator does not predict the future. It establishes a hard statistical baseline of human consumption and institutional capital reallocation. This is a historical line chart of the XLE Energy ETF. It displays a clear bottoming pattern in October, followed by a consistent peak in May. This October to May window represents the highest probabilistic timeline to hold a long position in the energy market. Drilling down from the broad energy ETF into the specific oil and gas refining subsector, the chart shows the identical October to May seasonal curve, verifying that the capital flow is localized. Within that precise subsector sits a specific target equity, Sunoco, ticker SUN. Mapping Sunoco's individual historical performance reveals perfect alignment with the macro October to May seasonal baseline. When you execute the trade at the individual stock level, it is backed by the massive, verified capital flow of the entire sector, heavily skewing the risk-to-reward ratio in your favor. Shifting focus to the retail sector ETF, ticker XRT, reveals a completely different seasonal timeline. Retail seasonality is driven by highly predictable consumer surges, specifically the late summer back-to-school rush and the winter holiday shopping season. This multi-year chart of Macy's demonstrates how price historically bottoms out in summer, followed by consistent bullish upswings from September through May. Traders accumulate long positions during these quiet summer months before massive retail earnings are ever reported. The specific value of seasonal analysis is that it allows you to establish a statistical probability position before the mainstream media reports the fundamental event. Seasonal analysis maps historical probability, but it cannot predict sudden macroeconomic recessions or unexpected supply and demand shocks. That gap is solved by the convergence principle. Seasonality tells a trader when to look at an asset, but technical momentum indicators dictate whether to actually execute the trade. A clear example of this bearish convergence occurred in the January options market for Google. This chart shows a distinct warning, a shooting star pattern forming at the rally's peak. Adding on-balance volume exposes bearish divergence. Price rose while buying volume dropped. Overlaying the seasonal trend reveals this peak formed January 4th, historically the start of Google's deepest annual decline. The alignment of these three independent factors immediately preceded an 8.25% market drop. The trader did not need inside knowledge of Google's upcoming earnings report. The convergence of the temporal baseline and the immediate technical weakness proved the asset was structurally overvalued. Operating in the market without a structural plan guarantees anxiety and forces you into reactive, emotional errors. Systematic execution requires a strict sequence of operations. Start at the broad index, filter down to the sector ETF, isolate the subsector, and finally target the individual equity. High-probability trading relies on the strict mechanical alignment of macroeconomic sector mapping, temporal baseline probabilities, and technical momentum.